Lately, it feels like international headlines are exploding almost every single day. The US and China keep sanctioning each other. China suddenly tightened rare earth exports. And right away, the US hit back, expanding its tech restrictions. Global supply chains are under stress again, and the geopolitical tension just keeps getting heavier. At the same time, US Treasury yields have surged to the highest in decades. Some forecasts say that in fiscal year 2025, net interest payments will break $1 trillion. That means, for every $5 collected in tax, almost $1 is going just to pay interest on past borrowing. And the number is still climbing. The US dollar, once seen as the safest asset in the world, is now turning into the biggest source of risk. It's not just foreign central banks refusing to buy treasuries anymore. They're actually dumping them at the fastest pace in 50 years and rushing into gold instead. Goldman Sachs even warned, if US bond funds shifted just 1% of their assets into the gold market, the price of gold could shoot up to $5,000 an ounce. So here's the big question. How did the dollar go from being the safest to the most dangerous? And will this crisis eventually hit our pensions, our mortgages, maybe even our jobs? Today, I'll break this down step by step. Treasury stress, central banks buying gold, the contradictory AI boom in stocks, all the way through to inflation and the impact on daily life. This is the full story of the dollar facing its biggest test. Recently, a very dangerous signal came out of the US bond markets. For decades, treasuries and the dollar were seen as the safest assets. But now, they're being sold off on a massive scale. This year, US Treasury yields surged to multi-decade highs, meaning the government's borrowing costs are soaring. In just the past 12 months, the US deficit hit $1.9 trillion. Interest payments alone are nearly $1.13 trillion, about 17% of total government spending. In other words, Washington is not only running a deficit, it's also paying more and more just to keep borrowing. And in May 2025, Moody's officially downgraded US credit from AA to AA1. The first time in over a century, America lost its perfect rating. The result? The dollar kept falling, treasuries were dumped, and investor confidence collapsed. But here's the catch. The US doesn't exist in isolation. Treasuries are the backbone of the global financial system. Central banks, pension funds, insurance companies, everyone holds them. So when treasuries get sold off, it's not just America that bleeds. Japan, Europe, the UK, Australia, their bond markets all fell together, and yields shot to multi-decade highs. That means America's debt problem is no longer just America's problem. It has become the central risk for the entire global system. What's even more worrying is the shift in investor behavior. Traditionally, whenever there was a crisis, money flowed back into treasuries. But not this time. Now, big capital is flowing into gold, and even crypto, rather than blindly buying US debts. Why? Because of the gap between nominal and real interest rates. On paper, treasuries pay 4 or 5%. But with inflation, most of that return gets eaten away. So investors no longer believe treasuries preserve value. They'd rather turn to other safe havens. This is a very dangerous signal. It means the dollar is slowly losing its role as the world's ultimate safe harbor. And history shows us, every sovereign debt crisis eventually spills into ordinary people's lives. In 1998, Russia's crisis crushed pensions overnight. In 2010, Greece's crisis slashed pensions and healthcare, and unemployment shot to 27%. The lesson is clear. Governments never pay the price of a debt crisis. Ordinary citizens do. Now, America is showing the same signs, just on a much larger scale. If dollar trust really collapses, it won't just be Americans who suffer. It will hit pensions, mortgages, borrowing costs, even jobs worldwide. And the scariest part? America's deficit and interest costs are not temporary. They are structural. Trump's new policies are projected to add another $3.4 trillion in deficits over the next decade. When income can't keep up with expenses, the government has only one option left: print more money. And that means another wave of inflation is already building. If Treasury stress is the economic side of this crisis, then geopolitics is the spark making it worse. The US rolled out new sanctions, targeting Chinese oil and refining firms. China struck back by restricting rare earth exports. And remember, China controls about 70% of global rare earth supply. Rare earths are critical for chips, EVs, and AI hardware. If supply tightens, the whole tech chain feels the pain. But instead of backing down, the US doubled down. Tariffs as high as 100% on some Chinese imports. Even stricter bans on advanced chip exports. In other words, the trade war just escalated to a whole new level. This isn't just US and China companies at risk. The entire global supply chain is caught in the middle. For investors, this cycle of sanctions, counter-sanctions, escalation means one thing: long-term uncertainty. And money always flows away from uncertainty, out of dollar assets, into safer havens. On top of that, the US is unstable at home too. In recent years, government shutdown threats have become routine. Fights over debt ceilings and budgets nearly left Washington without money to operate. In 2023 and 2024, government paychecks were delayed, public services were halted. To the world, this isn't just about deficits anymore. It looks like political dysfunction, and that weakens global trust in the dollar. There's also the long-term issue of dollar weaponization. Since the Russia-Ukraine war, the US has frozen reserves and cut countries off from SWIFT. Short-term, it worked. But long-term, more nations are asking, what if we're next? What if America pushes us out of the system too? And the numbers confirm it. In the last decade, foreign central banks' dollar holdings have dropped from over 70% to about 58%. One event after another has piled up, and the result is clear. For international investors, the dollar is no longer an asset they can trust unconditionally. When trust in treasuries and the dollar falls, money looks for new shelters. And in the past year, the biggest trend has been gold. From 2024 to 2025, central banks bought gold at the fastest pace in 50 years. Dollar reserves fell, gold reserves rose. This isn't just short-term panic. This is a structural shift at the central bank level. Goldman Sachs even estimated, if just 1% of US bond funds moved into gold, the price could jump to $5,000 an ounce. Why? Because the gold market is relatively small. When big money moves, prices explode. But it's not just gold heating up. Silver, the so-called poor man's gold, might be even more explosive. It's both a safe haven and an industrial metal. It's used in solar panels, EVs, electronics. So when inflation pushes costs up and tech demand rises, silver gets a double boost. And then there's Bitcoin. Its role isn't to replace gold, but to provide another de-dollarized escape route. Decentralized, borderless, outside US control. It appeals to sanctioned states and capital-restricted regions. But Bitcoin has its flaws. Ownership is highly concentrated. Just a handful of whales control most of the liquidity. Recently, one sell-off caused prices to crash 10 to 15% overnight. For ordinary investors, the risk is huge. I talked about this in detail in a previous video, so if you're curious, feel free to check that out. So, yes, Bitcoin is a new path to de-dollarization. But compared to gold, it can only ever be a high-risk supplement, not a true replacement. Logically, rising bond yields should crush stock valuations. Higher borrowing costs lower present values. But right now, US stocks are still strong. Why? Because most of the rally is concentrated in just a handful of AI megacaps. Reports say roughly 10 AI megacap stocks have driven about 70% of the S&P 500's gains. In other words, a few giants are holding up the whole market. The standout, of course, is NVIDIA. I've covered NVIDIA in another video, but to sum up, it dominates AI chips, invests across the ecosystem, and even launched its own infrastructure fund. Some call this its DNA strategy, making the entire AI supply chain more and more dependent on it. But risks are rising. China just tightened rare earth controls again, adding more elements and tech to its restricted list. Remember, China controls about 70% of supply and 90% of processing capacity. If rare earths and tech inputs are squeezed, chip and AI hardware costs will spike. So the US stock boom is fragile. It rests on a handful of companies. If supply chain costs keep climbing, both valuation and inflation pressures could explode at the same time. And the market could flip from bullish to bearish in an instant. So here's the reality. The dollar and treasuries are no longer absolute safety. The assets once most trusted are now the biggest risks. For ordinary people, that creates a dilemma. Cash will always lose value over time. It can't fight inflation. But markets are full of bubbles, so investing carries short-term risks and volatility. The conclusion is simple. Investing doesn't guarantee winning, but not investing almost guarantees losing. So the only real solution is diversification. Gold, the oldest safe haven. Silver, with both industrial and safe haven value. Stocks, especially in growth sectors like AI, semiconductors, clean energy, and healthcare. Crypto as another path to de-dollarization, but only in small doses. And the practical principle is clear. Don't go all in on one thing. No heavy bets on just one stock. No all in on gold. Instead, spread assets across safe havens, growth sectors, and riskier assets, based on your own tolerance. The proportions can vary, but the rule stays the same. Never put all your eggs in one basket. That way, even if the dollar and treasuries shake again, your portfolio can stay balanced, and you might even capture new opportunities during this market transition. Today's global market can be summed up like this. The dollar crisis is the main theme. Inflation pressure is the background music. With Treasury yields soaring, deficits expanding, and political trust eroding, plus US-China confrontation and geopolitical conflicts heating up, the cracks in dollar hegemony are finally visible. As capital flows out of treasuries and into gold, silver, and even crypto, every shift adds more inflation pressure. Because demand for safe havens never disappears. It only makes the old system weaker. So the real question isn't if the dollar gets hit. It's, when dollar power keeps fading, how do ordinary people protect their pensions, mortgages, investments, and even basic living? The only answer is diversification. Use gold to preserve value, stocks to chase growth, silver and clean energy to ride the new cycle, and a small allocation to digital assets to face a world that's entering a new, multipolar financial order. If you found this breakdown useful, don't forget to like and subscribe. I'll keep sharing clear, fact-based analysis to help you understand what's really happening in the global markets and how it connects to your own financial future. Stay tuned, because in a world this uncertain, having the right perspective is already a form of protection.